Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today we're sharing 5 stories. First, OpenAI CEO Sam Altman calls the AI industry a bubble, all while his company reportedly targets a staggering $500 billion valuation. Second, we'll look at how data centers from Google and Microsoft are creating an energy crisis in Malaysia, threatening to consume 20% of the country's power. Third, Google is partnering with Kairos Power to build an advanced Generation 4 nuclear reactor in Tennessee, a massive bet to power its AI ambitions. Fourth, a look at Europe's digital sovereignty crisis, as Amazon, Microsoft, and Google now control 70% of its critical cloud infrastructure. And fifth, a crypto bloodbath where a $500 million liquidation cascade wiped out 131,000 traders after a devastating inflation report and a Treasury announcement. The CEO of OpenAI, the company behind ChatGPT, just went on the record with a statement that has the whole industry talking. He thinks the entire AI sector is a bubble. Sam Altman says smart people are getting overexcited, directly comparing this moment to the infamous .com bust that wiped out nearly 80% of the Nasdaq's value. But here's where the situation takes a more complex turn. While Altman is sounding the alarm, his own company is cashing in like never before. CNBC has confirmed OpenAI is preparing a stock sale that could value the company at a staggering $500 billion. Now, it's important to understand that this isn't a typical investment where the company gets new cash. It's a secondary stock sale where employees and early investors can sell their shares. This provides a way to gauge market value, but it creates a paper valuation, a price set in a private market that can feel disconnected from the company's actual financials. That's a huge jump from a $300 billion valuation just a few months ago, following a record-shattering $40 billion funding round. Believe it or not, even as he talks about this, Altman says OpenAI is on track for $20 billion in recurring revenue this year, and yet it remains unprofitable. The reason for this paradox lies in the astronomical operational costs. The sheer expense of running these massive models is immense. Every time you ask ChatGPT a question, it costs money in computing power. That's called inference, and it's estimated to cost OpenAI $4 billion a year. On top of that, training new models can cost up to $3 billion annually. These numbers reveal the fundamental challenge of the AI business. Delivering this tech at scale is almost unimaginably expensive. This all leads to a critical question about the company's real strategy. OpenAI's latest model, GPT-5, had a rocky launch, with some users complaining and forcing the company to restore access to older versions. Interestingly enough, right around the same time, a fascinating strategic shift occurred. For years, Altman was a huge promoter of AGI, or artificial general intelligence, but recently he started saying the term has become pointless and is losing relevance. By downplaying the AGI goal after a rough product launch, he might be trying to manage expectations and sidestep the regulatory scrutiny that comes with promising world-changing superintelligence. At the same time, Altman is talking about spending trillions of dollars on data centers in the not very distant future and has signaled interest in buying Chrome if Google were ever forced to sell it. That kind of trillion-dollar build-out faces immense real-world obstacles, not just financial ones. We're talking about a massive strain on global resources. Experts project that by 2030, data centers could consume up to 3% of all global electricity. And the water footprint is staggering. By 2027. AI operations alone could use more water annually than the entire country of Denmark just for cooling. These are the physical choke points that could derail such ambition. The central conflict is a CEO warning of a bubble while simultaneously riding it to an astronomical valuation. And when asked if he'll still be the CEO of OpenAI in 3 years, Altman's answer was stunning. He said, and I quote, maybe an AI is in 3 years. That's a long time. Speaking of the immense resources needed for AI, that ambition is creating a very real crisis on the ground today. The AI boom is on track to consume a staggering 20% of an entire country's energy supply by 2035. The front line of this resource war isn't Silicon Valley. It's a state in Malaysia called Johor, which has quietly become one of the world's fastest growing data center hubs. Tech giants like Google, Microsoft, and ByteDance are flooding in, building massive server farms drawn by cheap land and resources. However, there's a huge problem. After welcoming billions in investment, local officials are now hitting the brakes. The planned data center capacity in Johor is nearly 10 times its current size, and the state is struggling to keep up. And it's not just power. A single average-sized data center can consume over 4 million litres of water every single day. That's the equivalent of the water supply for thousands of residents in a region that has already experienced supply disruptions. For the people living there, this means that while these data centers bring jobs, they also bring a heavy burden. Residents in Johor have reported more frequent power outages and water disruptions. In fact, just a few years ago, over 250,000 residents were hit with water rationing. This is the real cost for the host community. But that's not the whole picture. The real turning point was when the financial hub of Singapore cracked down on new data centers over these exact same concerns. The industry simply packed up and moved next door to the friendlier regulatory environment in Johor. It's a resource-intensive game of whack-a-mole. The context here is that Singapore put a moratorium on new data centers from 2019 to 2022 to get its own environmental impact under control. During that exact period, Johor's data center capacity exploded, growing from just 10 megawatts to a massive 1.3 gigawatts. It's a classic case of what experts call resource arbitrage, where the environmental burden is simply shifted across the border. This isn't just a Malaysian story, it's a preview of a global challenge. In the United States, the world's largest data market, one analysis projects that by 2030, the growth in data centers could raise American electricity bills by 8% and increase greenhouse gas emissions from power generation by 30%. To meet that insane demand, some regions are being forced to delay the retirement of old fossil fuel plants and even build new gas-fired power plants. This creates what's called carbon lock-in, trapping us in fossil fuel dependency for decades to come and directly contradicting climate goals. This is a choice being made right now. The situation poses a fundamental question. Is this growth sustainable? One leading researcher on technology and the environment puts it bluntly, stating that there is no reason for tech companies to abandon climate goals just because they claim their expansion is urgent. He says, quote, "Whether we move towards net zero emissions is a choice." While some regions are clearly struggling with that energy demand, Google is making a bold, and some might say radical, move to solve it. The tech giant just announced it's going nuclear, building a new advanced nuclear power plant in Tennessee. The reason? Its insatiable hunger for energy. Artificial intelligence is demanding so much electricity that it's pushing power consumption to record highs, and a new source of massive carbon-free power is needed to keep the lights on for big tech. This hunger is exploding. A recent report revealed that in 2023, AI data centers accounted for about 4% of US electricity demand. By 2028, that number is projected to triple to 12%. That's an unprecedented surge, and it's forcing a complete rethink of our energy infrastructure. So Google is partnering with Kairos Power and the Tennessee Valley Authority to build what they're calling a 50 gigawatt small modular nuclear power plant. This single project aims to power Google's massive data centers across the US Southeast with enough capacity to also supply about 350,000 homes. So, what exactly is a small modular reactor, or SMR? Unlike the giant custom-built nuclear plants of the past, SMRs are designed to be smaller, built in a factory, and assembled on-site. The idea is to make them faster and cheaper to build, providing reliable, carbon-free power exactly where it's needed, like right next to a massive data center. This is a landmark moment. This is the very first time a US utility has ever signed a power purchase agreement for what's called Generation 4 nuclear technology, widely considered the most sustainable and safe form of nuclear power currently in development. This Generation 4 tech is a potential game changer. The reactor from Kairos Power uses molten fluoride salts as a coolant instead of water. This allows the reactor to operate at very high temperatures, but at very low pressure. The significance of this is that high pressure systems, like in older reactors, carry a risk of explosive failure. By operating at low pressure, these new designs practically eliminate that risk, making them fundamentally safer. However, if you zoom out, you'll see another layer of strategy at play. The US Energy Secretary just dropped a major statement on this project, declaring the deployment of advanced nuclear reactors is essential to USA dominance and energy leadership. Behind that statement, we're seeing the outlines of a global AI Cold War. The US is betting on advanced nuclear to power its AI infrastructure. Meanwhile, its main competitor, China, is taking a completely different path with its massive Eastern data, Western compute strategy, moving data centers to its Western provinces to power them with renewable energy like wind and hydro. So this Google deal isn't just about servers. It's a strategic move to secure a national advantage. Suddenly, this isn't just about Google's servers. It's a move in a global power struggle, tying the AI race directly to a new generation of nuclear energy. The ultimate gamble is that right now, there are no commercially available advanced nuclear power plants in the US. This entire plan is a bet on a future that doesn't exist yet. From a story about national competition, we now turn to a continental one. It's a scenario being seriously debated in Europe right now. Could the US government flip a single switch and turn off Europe's internet? It sounds like a wild conspiracy theory, but it's based on one jaw-dropping number. Just 3 US giants, Google, Microsoft, and Amazon, provide a staggering 70% of Europe's entire cloud computing infrastructure. That's the digital scaffolding for everything. The core of the problem is economies of scale. Because these companies are so massive, they can offer services at a cost that smaller European competitors just can't match. They've built a kind of digital fortress that's incredibly hard to break into. One policy advisor warns that if that switch were ever flipped, critical data would become inaccessible, websites would go dark, and essential state services like hospital IT systems would be thrown into chaos. And this isn't just a hypothetical fear. Just recently, the top prosecutor at the International Criminal Court, Karim Khan, reportedly lost access to his Microsoft Outlook account after being sanctioned by the White House. That single incident sent shockwaves through Brussels, turning the idea of digital sovereignty into an urgent crisis. The core conflict is clear. Europe's massive dependence on American tech. The numbers don't lie. A recent report from former European Central Bank head Mario Draghi noted that only 4 of the world's top 50 tech companies are European. Microsoft's president, Brad Smith, has tried to calm fears, even promising his company would take legal action against the US government if it ever ordered a shutdown. But some in Europe aren't waiting. After all, there's a fundamental legal clash happening. The US has the Cloud Act, which allows American authorities to demand data from US companies, no matter where that data is stored. This directly conflicts with Europe's own strict privacy law, the GDPR. So even with the best intentions, Microsoft is caught between 2 opposing legal systems. As a result, the German state of Schleswig-Holstein is already in the process of phasing out Microsoft products in favor of open source alternatives. We're talking about a massive undertaking to transition 30,000 government computers off of Microsoft Windows and Office to Linux and LibreOffice. The goal is not just digital independence, but also significant cost savings. But can Europe truly decouple? One expert calls these tech markets winner takes all, meaning once a company is on top, it's almost impossible for anyone else to catch up. A key reason is a concept called data gravity. The more data you store with one provider, like Amazon or Microsoft, the harder and more expensive it becomes to move it somewhere else. Your data is essentially locked in by its own weight, creating a powerful barrier for any potential competitor. So what's the end game? Instead of trying to beat the US giants at their own game, some experts believe Europe's best strategy is to dominate specialized high-tech niches. For example, the Dutch company ASML has a near total monopoly on the complex machines needed to make the world's most advanced computer chips. Europe could focus on winning in areas like industrial AI or next-gen manufacturing, creating its own unique strengths. As one analyst noted, 2 years ago, we didn't think we would be talking about these topics. Now, organizations want to get ready for what might happen from the reliance on centralized digital infrastructure. Let's pivot to the volatile world of decentralized finance. Over $500 million in crypto was just forcibly sold off, triggering a market-wide plunge. In the past 24 hours, more than 131,000 traders saw their positions liquidated in a fire sale, totaling $552 million. That's $123 million in Bitcoin and $178 million in Ether wiped out as traders were forced to sell and cover their debts, pushing prices even lower. This wasn't just people panic selling. It was an automated, brutal process called a liquidation cascade. Many traders on these exchanges use leverage, sometimes borrowing up to 100 times their own money. When the market dips even slightly, their collateral isn't enough, and the exchanges system automatically force sells their assets to cover the debt. This selling pushes the price down further, triggering the next trader's liquidation and the next a domino effect run by algorithms. What's really jarring is that this collapse comes just days after Bitcoin smashed its fourth all-time high this year, touching nearly $125,000. Ether was also within spitting distance of its own record before the floor fell out from under both. So what lit the fuse? The trigger was higher than expected inflation data, raising fears that a promised Federal Reserve rate cut might be off the table. The fact that a Fed decision can rock the crypto world so hard shows how much the game has changed. With the recent introduction of spot ETFs, massive institutional money has poured into Bitcoin and Ether. This has made crypto more mainstream, but it also means it's now tied to the hip of the traditional economy. We're in a new era where crypto prices are more influenced by things like inflation reports and interest rate decisions, but the pressure didn't stop there. Treasury Secretary Scott Bessent clarified that the US Strategic Bitcoin Reserve will be confined to Bitcoin forfeited to the government. He stated they are only exploring budget-neutral pathways to acquire more Bitcoin, crushing hopes of massive government buying. To put that in perspective, the US government already holds around 200,000 Bitcoin from criminal seizures. The hope in the market was that the government would start actively buying Bitcoin as a national asset, like it holds gold. Bessent's statement poured cold water on that idea. This sent a shockwave through the market, hitting not just Bitcoin and Ether, but also crypto-related stocks like Bitmine Immersion and SharpLink Gaming. Companies like these have become massive corporate treasuries for Ethereum, holding hundreds of thousands of Ether on their balance sheets. When the price of Ether plummets, the value of their core assets gets crushed, and their stock price follows suit, showing a growing trend of centralization in a supposedly decentralized network. And yet, the situation presents a fascinating duality. On one side, you have short-term, high-leverage traders getting wiped out by macroeconomic news. On the other, long-term institutional investors are using these new ETFs to buy the dip. In a stunning twist, Ether ETFs just logged a record week of inflows, pulling in $2.9 billion. This suggests that while speculative froth is being blown off the top, the foundational long-term investment thesis remains strong for many. The question now is whether this was a fatal plunge or just the deep breath before the next massive surge.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.